Market downturns can be unsettling. Watching your portfolio shrink day after day can make you wonder, should you stay invested or cut your losses? Is this just another correction, or are we in for a long, painful bear market? History shows that every market correction eventually ends, and those who stay invested often reap the biggest rewards. But how long will this phase last, and what can past bear markets teach us about recovery? And most importantly, how could you position your portfolio right now? Let's break it down in this video. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So first, stock market corrections, crashes and bear markets aren't flaws in the system. They are a natural part of equity investing. But isn't that what makes market work? So just like opening a window brings in fresh air along with the occasional whiff of smoke, investing in equities creates long-term wealth but comes with inevitable downturns. And here's the real question. Aren't these pullbacks actually necessary? They help clear the excesses built up during euphoric rallies, keeping the system balanced. Now, why do bear markets happen? Bear markets don't just appear out of nowhere. They happen when investor sentiment swings sharply from greed to fear. But why does this shift occur? During bullish phases, excess liquidity floods the market, pushing both strong and weak stocks to unsustainable highs. Investors who shouldn't even be taking on volatility, like those using emergency funds or short-term savings, get swept up in the excitement. The result? Overinflated valuations with little fundamental backing. Then comes the correction. The market does what it always does. It separates the wheat from the chaff. Investors start distinguishing between high-quality businesses versus overhyped stocks. Certified financial planners focused on solid investments versus advisors chasing the latest fads. So fund managers with strong portfolios versus those simply riding short-term trends. In the end, bear markets serve a vital purpose. They reset the playing field, ensuring only fundamentally strong stocks and sound investment strategies stand the test of time. Every bear market has one thing in common. It eventually ends. And not just that, but markets always recover to new highs. Don't believe it? You can see the numbers speak for themselves in the tabular column presented on the screen. What are the key takeaways from the market data presented here? You can see that corrections are temporary. No matter how sharp the decline, markets have always bounced back. Recoveries are powerful. The returns from recovery period often surpass expectations. So, should you really panic and sell when the data shows that patience pays off? Number 4. If you're working with a certified financial planner, chances are your portfolio is already built to handle market downturn. But how does a strong investment strategy protect you? First, emergency funds stay in liquid funds or fixed deposits, not in stocks. Next, short-term goals, which is like under 3 years, are backed by debt funds, shielding them from market volatility. Next, we have long-term goals, which is like 5 to 7 plus years. So it maintains a balanced allocation, typically 70 to 80% in equities with the rest in gold and debt. This ensures that even during a bear market, you have enough liquidity for the next 4 to 5 years, eliminating the need to sell at a loss. Now, number 5 is retail investors, especially those using low-cost investment platforms, often fall into a common trap, chasing returns without a structured plan. But without a solid investment process, how do you handle market volatility? First, there's too much small cap exposure, which is like 2024. As you can see in the 2023 to 2024 bull run made small cap and mid cap stocks look unstoppable. Many DIY investors went all in, expecting the rally to continue. But isn't this a classic case of recency bias? Small caps are highly volatile, and when the tide turns, the fall can be just as sharp as the rise. Next, emergency and short-term funds in equities, which is a costly mistake. You see, in euphoric markets, investors often move critical funds, emergency savings, and short-term gold money into equities, chasing quick returns. But what happens when the market corrects? Financial stress, forced selling, and regret. Number 3, chasing gold in 2025 is equal to chasing small caps in 2024. As you can see, now that gold prices are soaring, many investors are shifting their money from equities to gold. But is this sound investing or just another round of trend chasing? Gold and equities serve different roles, and over allocating to one just because it is performing well today is repeating the same mistake. Number 4, investing needs a process, not just a platform. Because you see, platforms make transactions easier, but do they help you invest wisely? Investing isn't just about picking stocks or funds, it's about having a structured process. Without a solid strategy, how do you ensure the right asset allocation and risk management? A certified financial planner or mutual fund distributor can provide the guidance that platforms like these simply don't. And next we have number 6. How long will this bear market last? Will the stock market recover soon? What's the longest bear market in history? The dot-com crash of 2000 led to the longest correction in Indian markets. 20 months of decline followed by a 27-month recovery. So where are we now? The current market correction has been going on for 6 months. If history were to repeat its worst case scenario, could we be looking at another 14 months before things turn around? But here's the important question. Is this time different? Unlike the dot-com crash, which was a sector-specific bubble driven by overvalued tech stocks, the 2020 to 24 bull run was broad-based, supported by multiple sectors. Could this mean the correction will be shorter? History doesn't always repeat, but it often rhymes. Number 7. Market recoveries often feel stronger than the fall. But why? The answer lies in the base effect. If a stock or index drops 50%, it needs a 100% gain to return to its original level. The fall is measured from a high base, while the recovery starts from a lower one. As you can see, I can give you some historical example like 2008 crash when Nifty plunged 60% but then rebounded 149% in just 25 months. And another example is the 2020 crash. Nifty fell 38% only to bounce back 62% in 8 months. So why does this matter right now? Because investors who stay invested, or better yet, continue investing during a correction can benefit massively from the recovery. Will you take advantage of this opportunity or will fear keep you on the sidelines? Number 8. Volatility is just a natural part of stock market investing. So why fear it? Think of it like opening a window for fresh air. Yes, some dust or smoke might come in, but does that mean you should never open the window? Similarly, investing in equities comes with occasional corrections, but that's just part of the journey. The real risk? Panic. Stopping your SIPs or withdrawing investments out of fear doesn't protect you. It locks in your losses and keeps you from benefiting when the market rebounds. So ask yourself, are you reacting to short-term noise or are you staying the course? Number 9, patience isn't just a virtue. It's one of the most powerful investment strategies. You see, markets transfer wealth from the impatient to the patient. History proves that those who stay the course during downturns are the ones who reap the biggest rewards when the recovery begins. Boring but effective. Investing isn't about making constant moves. It's about staying invested long enough for compounding to do its magic. So can you resist the urge to react to every market swing? Number 10. Market volatility looks extreme when you zoom in on short-term movements. It's enough to make anyone nervous. But what happens when you zoom out? Despite multiple corrections, markets have always grown over the long-term period. Every dip in history has been followed by a strong recovery. So in 1979, the Sensex was just 100 points. In 2025, Sensex is just over 73,000 plus points. That's a 730x increase over 46 years, translating to an average CAGR of 15.14%. So what does this tell us? When you look at a long-term chart, short-term market crashes barely register. They are just minor dips in an otherwise upward journey. So are you focusing on the daily noise or the bigger picture? Number 11. A disciplined investor doesn't just ride the market waves, they rebalance. You see, what did smart investors do in the 2023 to 24 bull run? They didn't just sit back and watch their portfolio grow unchecked. With a certified financial planner, they took proactive steps. They reallocated excess equity gains into safer assets like debt or gold and kept their asset allocation balanced to protect gains from volatility. And when markets corrected, they weren't scrambling to protect their profits, they had already secured them. And was small cap overexposure avoided? You see, small cap stocks skyrocketed in 2024, as I have previously mentioned. But experienced investors knew better than to go all in. Prudent investors took action by reducing small cap SIPs as valuations became overheated. They shifted their funds towards large and mid caps for stability, and they booked partial profits in small caps and reinvested in more stable categories. Then the correction hit. Those who had blindly chased high returns in small caps suffer the most. But what about DIY investors? You see, many individual investors without a structured approach made these classic mistakes, like kept increasing exposure to small cap, ignoring valuations. They didn't rebalance, letting their portfolio drift into risky territory. And they held on to small caps during the peak, only to panic when the market corrected. So, what happened next? They faced extreme volatility and lost significant gains. So number 12, SIP investors. Here's something you might be overlooking. NAV and units move in opposite directions. When markets rise, NAVs increase, so your investment buys fewer units. When markets fall, NAVs drop, which means you accumulate more units for the same amount. And that's exactly why SIPs work. By investing consistently, you automatically buy more when prices are low and fewer when prices are high, taking full advantage of market fluctuations. Think of it like this. Bull run for NAV is equal to bear run for units because fewer units are accumulated now. And bear run for NAV is equal to bull run for units because more units can be accumulated now. So the longer a bear market lasts, the more units SIP investors accumulate at lower prices. And when the market eventually bounces back, those extra units translate into significant gains. This is why bear markets aren't an SIP investor's enemy, they are your best friend. So why fear downturns? Smart investors see market corrections for what they truly are: golden opportunities to buy quality assets at a discount. Number 13. One of the biggest mistakes investors make is chasing past returns instead of following a disciplined approach. I will give you one example. In 2024, small cap stocks delivered exceptional returns. What happened? Many investors over allocated funds to small caps. Now, small caps are seeing major losses. Another example is 2025 gold prices are soaring. So what's happening? Investors are shifting all their money into gold. But chasing past returns is never a sound strategy. Instead, long-term investors should continue their equity SIPs. If possible, invest lump sum via systematic transfer plans into equity mutual funds. Why? Because history shows that bear markets are temporary and recoveries are strong. The biggest gains often come right after the worst downturns, and only those who stay invested benefit from rebounds. So number 14, putting all your money into mid caps and small cap funds, moving everything into gold, that's just risky. Markets move in cycles and no single asset class outperforms forever. Instead, a well-balanced portfolio includes large cap, mid cap and small cap equities for growth, and gold and debt funds for stability. The goal: consistent risk adjusted growth over the long run. So ask yourself, are you diversifying wisely? Number 15. Many investors exit the market at the worst possible time, right after a correction. But let's think logically. Why sell when prices are low? If you don't need the money immediately, why not stay invested and let your portfolio recover? History proves that markets rewards patience. So those who panic and redeem early often miss out on the strongest rebounds. The real question isn't whether the market will recover, It's whether you will still be invested when it does. Number 16. Not all mutual funds are created equal. So, how do you pick the right ones? You need to look for a strong track record, experienced fund managers, and a consistent investment strategy. A fund that performed well in one bull run may not necessarily do well in the future. Past performance alone isn't enough. Does the fund have a solid process? If you're not sure how to choose, you can seek professional guidance from a certified financial planner or a mutual fund distributor. So, what is the final takeaway from this video? Market corrections and bear phases are inevitable in equity investing. Instead of fearing them, recognize them as opportunities to accumulate wealth. Bear markets are temporary. History shows that every downturn eventually ends. The best returns comes to those who remain invested, follow a structured investment process, and don't panic during downturn period. The market always rewards patience and discipline. Those who panic and exit during bear markets transfer their wealth to those who stay invested. So instead of trying to predict market movements, trust the process, rebalance when necessary, and use market corrections as an opportunity, not a threat. Remember, the market does not punish disciplined investors. Instead, it rewards them. So if you want professional guidance like this, click the link in the description to book a free consultation with one of our certified financial planner today. And if you find this video interesting, give it a like, share, and subscribe to our YouTube channel. I will see you in the next video with much more interesting financial insights. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.